So excited to be here with you today, my friends. It is good to see you. My name is Jimmy Lee. I'm with the Institute, and we have some exciting information to talk about today about you, about your shop, about your future, and being able to adopt some of those strategies of the top 1%. The top 1%, they do invest a little bit differently than the rest of us that might have a 401k, or you might have a small Acorn account. This is above and beyond. This is some next level stuff. So I'm super excited for these conversations that we'll be having today. My name is Jimmy Lee. I'll be the host with the most for you today as we MC this gauntlet of information coming to us fast and furious from our good friend, Mr. Derick Van Ness. Derick is a very good friend. He and I have been friends for a very long time, all the way back to our freshman year in college, as we both pledged the same fraternity together. And most recently, Derick Van Ness, the best man at my wedding. Derick, how are you, brother? Good to have you here.
Happy to be here, Jimmy. Excited.
I'm excited as well. Let me give a shout out to Big Life Financial. Big Life Financial is a small business owners where we turn success into lasting wealth. They simplify tax strategies, they automate wealth building, and they structure businesses for the maximum value. With 15 plus years of experience, they make financial planning easier so you can focus on what matters, which is your customers, your clients, and keeping people safe on the road. With that, Derick, thank you for joining us today. I'm excited. You and I have had these conversations in the past. We have been able to talk about this. This is some next level stuff. I really love it. I love that the automotive industry is so receptive to your message talking about wealth strategies of the 1%.
Yes, yes, it's been awesome. You've introduced me to the industry. What was it? Probably just a little before COVID. So it's been about 5 years now, and worked with 100 plus
Yeah,
shop owners since then. In going to events and speaking and doing
you,
webinars like this and trainings for people. And I'm
I,
excited to be at the summit. It's going to be an awesome event. This will be my first time, so don't hold it against me, but it's going to be great. We're going to be sharing a bunch of different types of strategies. We'll have a booth, so if anybody wants to stop by, come say hi. I think we're going to be right by the food, so you'll probably wander through at some point, and it'd be great to meet you and shake your hand because obviously in person's always better. So
yes. Oh, I'm so excited for the in-person. And I think, Derick, it's going on 6 or 7 years ago that we brought and introduced you to the automotive industry. Because if we're going
could
before
be.
COVID, I remember doing a webinar together, you and I. I'm sitting in the hallway at my brother-in-law's house. No, my brother's house in Paulsbo, Washington. And that's the webinar where Bill Sr. was on.
Oh yeah, yeah, that's
Yeah, so
awesome.
that is a long time ago, brother.
That is a long one. I don't know, man. It's all a blur, but it's been a really fun ride.
It is a fun ride. Well, the floor is yours. I know you've got a couple of slides to share. You've got some artistic abilities, high level. No, let me lower the bar here. Everybody, Derick and I are on the stick figure level of artwork when it comes to our ability today with what Derick's going to, but you will appreciate the stick figures you're going to see today. So with that, Derick, the floor is yours, brother. Hopefully you can share screen.
I sure can. Can you guys
There we
see
go.
that? Yep. And so we're going to be talking today about, grow your business and build your wealth using the secret banking system of the 1%. And just to be clear, this is something that came from how the Rockefellers, how family offices, if you don't know what a family office is, people who have a net worth of like 50 million plus, they have a whole team of people. They've got their attorney, their tax guy, their insurance guy, their investment guy, probably more than one investment guy, the real estate guy, all their people together in one room working together just for that family and their wealth. This is one of the strategies that these people use. And the good news is, I mean, truly, some of those strategies just don't apply to guys who run small businesses. But this is one that's an absolute home run in my mind. I think it's one of the most foundational things you can do as a business owner. And Jimmy mentioned earlier, it automates building wealth, which is so important because you're always out there working on your business, taking care of your family, building the community, doing all the things that you do as a business owner and leader in your community. you don't always have time to try and figure out how to be the best investment person and do all these kind of things. This is one of those things you can put in place that runs in the background and builds a lot of wealth. So I'm going to break it down for you, but I felt like it was really important to say that. And I'm going to switch over to a little bit of a whiteboard. Can you guys see my whiteboard here or not?
No, not yet. It
Okay,
might be on your other
I gotta
screen.
switch my screen share real quick here so that it will be what's on my screen. Okay, better?
Not yet. Yes, better now. Okay,
Okay,
perfect.
very good. So we're gonna start one thing high level. I think this is just really good for you guys to know. The reason your business is successful is you have systems, right? I mean, that's why you're with the Institute. They help you guys figure out how to consciously build a business that works. We do the same thing on the financial side, and I call it a financial operating system, right? Instead of a business operating system. And it's composed of four parts, right? See, this is where the stick figure art comes in. The first one is we feel like people need to have a system for their taxes, right? And we're, not to plug too hard, but we're going to do another series in April with the Institute on how can you guys put tax strategies in place that are going to save you significant amounts of money. And I try to do everything 80-20. You guys aren't going to become tax professionals, but if we can help you guys to put in 20% of the effort and get 80% of the effectiveness, that's a big win in my book. And for a lot of shop owners, it's, $10,000 to $50,000 a year they can save in taxes. So it's a pretty big deal. The second system you want to have in your business is what I call growth or cash flow, right? You need to know how to grow your money and turn that into cash flow eventually. And we're going to talk about this today. I think you need to have systems and automation. I'll just put auto here. Don't think that's automotive, automation, so that these things are happening consistently. Like that's what makes your business work, right? You know how to price things, you know what your margins are, you know how to talk to clients, you know how to collect and work with insurance companies and all the different things that you have to do. And then the last thing is what we call safeguards and protection. Okay. I bring this out because I don't think anybody ever talks to you about having systems in your personal finances. A lot of you run a great business, but then when the money gets to the personal side, you have almost none of these. Just know this is what you need to figure out. And ideally, of course, having a team that can support this, the right team makes a really big difference, just like it does in your business, right? So that's just high level. I want to break down this 1% banking, but I wanted you to see where that fits. It's a system and it's designed to build growth and cash flow for you. Okay. So let's dig into this a little bit. As a business owner, when you make a dollar, you've always got this dilemma, right? Do I take this dollar and keep it available so that I can use it for my shop, right? Available. Okay. Available for your shop. Or you can take that money and you can put it to work and get it earning, right? How many of you guys think about this all the time? I got all this money in the bank and I got to keep it around, but it can't do anything for me, right? Or I've got a bunch of money sitting in a savings account. I mean, and I feel like I should be earning on it. I just don't know how or what to do. This is a constant battle as a business owner. The system we're going to talk about today helps you to do both so that you can have that money available for your business, but also have it earning and you don't have to do the either or. Okay. So let's talk a little bit about this. And I call this the money maximization model, because the idea is we want to get your dollars doing as many jobs as we possibly can, right? So it looks like this. This is the super high level, and then we're going to drill into it. You make money with your shop or other investments. Some of that money is going to go into the money maximization model here, right? And it's going to run through that. Now, I want to mention this because this word through means I'm building up money for a reason. A lot of times when we put money, like Jimmy talked about, in a 401k or an IRA or some of these other things, it goes in there and we can't get to it until we're 59 and a half, right? In this particular system, the money's going to be building up in here like it would in a savings account. But the difference is it's going to start doing multiple jobs for you. And that's the whole game. How do we get our money doing as many jobs as possible, as often as possible? And then you can take this money and you can still use it for your business, or if you want to buy real estate for your shop, or you want to invest, or you need it for taxes, or whatever else you decide you need it for. It's not that your money goes in here or you get to use it for these things. It's that you get to do both. Okay. What I'm going to show you is a system where you build up the cash here, and then as it makes sense, you deploy it for your business, for real estate, or to buy a shop or more locations, invest, pay taxes, etc. So this just adds an extra layer of profitability to everything that you're going to do business-wise and personally. And that's what makes it so powerful, is it's just going to enhance everything you're already doing. Okay. So let's break this down, this particular piece. I hope that all makes sense. So we're going to use, in this particular case, a specific vehicle. We like to use a specific type of whole life insurance policy. Okay. And I'll explain why we use life insurance and why it might not make sense to you. So if this box is a life insurance policy, what most people know about life insurance is this. There's two components. Most people know it's a death benefit, right? When it dies, or when you die, it pays out to your heirs. And the nice thing about life insurance is it does pay out income tax free, right? If you get to the estate tax, you got to do some of that, but income tax free, which is a great way if you need to pass 1, 2, 3, 5, $10 million onto your family for some reason or another. They don't have to pay income tax on that. That's a really big deal. Now, here's the problem with life insurance. Most people who do this don't work with business owners. And so what are they focused on? If you've ever gone to go get life insurance, they're going to say, hey, Jimmy, hey, shop owner, how much money do you have? Let's put as much of that as we possibly can into the death benefit. Now, when they do that, two things happen. One is they make more commission. Life insurance people, if you don't know this, and I'm licensed, right? They make their money on what goes into the death benefit. This is called your base premium. Okay. And so they, like salespeople, they sell what pays them the biggest commission. Here's the problem for you. If you're paying a huge commission, less of your money's going in here. And the worst part is we're trying to get money up here, not in the death benefit, but into the living benefit, which is the second part of life insurance that most people don't know anything about. And this is called cash value. Okay. As a business owner, we're trying to help you grow your cash. Yes, a death benefit can be important later on down the road, but if we're really focusing on how to help you build wealth while you're living, then we want to focus on cash value. When you put all the money into the death benefit, almost none of it goes up here for the first couple of years, and it really sets you behind. So if you ever hear bad stuff about life insurance, it's because somebody's doing it this way and it's not right. But life insurance is just like any other tool, right? You can take a wrench and fix a car, or you can use it to, break your finger, hit yourself in the hand, bust your knuckles trying to do something wrong, right? It's not about the tool, it's about how you use it. So if you do use these policies properly, what actually happens is we take as much as we can away from the death benefit and then put it directly up here into cash. So you're starting to build up cash, just like you would in an investment account or something else. In this case, it's a savings vehicle. And the difference between an investment and a savings vehicle, just a little background knowledge for you here, is an investment has a chance of loss. Life insurance, being a savings vehicle, does not have a chance of loss. There's no investment crashing, stock market crashing, any of that stuff. When we're talking about whole life insurance, it's not tied to any of that. Okay. So the idea here is using this as a supercharged savings account. And I'm going to explain in 1 second why it's supercharged, but I got to explain one thing before we get there. Pre-1984, you could buy a small death benefit and dump millions of dollars into cash in here, or even billions, and people did it because of the tax breaks it has. The IRS caught on to that. So they've put a limit on how much cash you can put into one of these policies. Usually, if the government puts a limit on it, it's pretty good, right? Um, but this IRS limit is called the MEC limit. And this is a little technical, and you don't have to know everything about it. But what that stands for is Modified Endowment Contract. I know that's like big words, but here's what it comes down to. Life insurance is an endowment contract. When you die, it endows and pays out. If you put too much money into it, they say it's modified and they treat it like an investment and you have to pay the taxes. We don't want to pay taxes. That's one of the huge advantages of doing this. So we want to fill this box right up to the line. And how we determine how we can fill that box up or how much we can put in, it's a big, huge, long formula, but it kind of comes down to this. For every dollar we put into cost of insurance, we can put about $2 up here into cash. Okay. If your health's a little different, if you're younger, if you're older, it's slightly different because the cost of insurance is different. But just know if you want to put more cash in, you have to buy a little more insurance. That's it. Now,
Okay. Question for you, Derek.
yes.
We have an international audience here.
Okay.
And Aaron, I'm assuming you're from tuning in from Canada. Let me know if it's different than that, Aaron. Put it into the Q&A. How does this apply to international or outside of the US? Are you able to
You are.
implement the same strategies, whether they're US based or Canadian or the
Yep.
UK or New Zealand or Australia?
I know for sure you can do it in Canada. I have an associate, he's very sharp, who does this for our clients in Canada. I'm quite sure the UK works under similar rules
Yep.
because I've heard of it being done, but I have not done policies for people in the UK, but we have connections to find that for you. So yes, and my assumption because of Australia being so tied to the UK, it's probably similar. So yes, it probably applies. I know for sure it applies in Canada though. Okay. And they have
Yeah.
very, very similar rules. Like this IRS guideline might be slightly different, but it's really close because essentially these life insurance companies are banks, right? And banks
Yes.
are trying to make it the best they can, and governments are trying to get their part, but they also don't want to do so much that people stop doing it because one thing life insurance does is it creates stability, right? Families that would normally be in a really bad spot aren't in such a bad spot. And then the government doesn't have to take care of them. So they like for these things to exist as safeguards
Yeah.
for people. So they try and incentivize it. Plus, to be quite honest with you, all the super wealthy people do this. And guess who controls governments? Super wealthy people. So
Yeah.
there's a reason life insurance hasn't really been under a lot of scrutiny or a lot of law changes or anything because the people who make the laws all have them, right?
Mm,
Right? Like
okay.
a quick thing to just kind of say for all of you guys, if you're wondering, this is kind of a higher level thing, is there's really three things all wealthy people have. They all have, just like you guys, they all have businesses, right? Why do they have businesses? Well, cash flow, but also you guys know businesses get insane tax breaks. And whether you realize it or not, taxes are the biggest cost in your life, even if you got kids in college. So that's how expensive they are. The second thing that all rich people have is they all own real estate, right? No surprise there. And a lot of shop owners own real estate. And if you've owned it for a while, it's a pretty darn good thing, right? When you depreciate that stuff and when you get cash flow off of it, there's a lot of tax breaks there. And the third thing that almost all rich people have is what's called cash value life insurance, right? It's because of the tax treatment right here that we're going to talk about that builds up inside of cash. These three things are pretty much a guarantee for anybody with any level of wealth. And so that's part of why we're bringing this in is a lot of you understand this. And of course, a lot of you probably understand this, but you probably don't understand this piece. And it really complements, they all work together. So that's just a side note. Let me tell you why right now this probably sounds like a really complicated savings account. Let me tell you why this is so valuable. Okay. Inside of cash value, the first thing is your money is liquid, right? Like we talked about, having access to cash for you as a business owner, it's just super important, right? If you've ever been caught short on cash, it sucks and it screws up your planning and cash flow makes everything work. So you want to have something where your money's liquid. In this case, it's like having an out-of-state bank. You can usually have your money in 3 to 5 days, right? You go online, you fill out a form, a couple days later, it's in your account. So you can't like run your business out of one of these accounts, but as your big savings, as your emergency fund, as your tax fund, as a lot of these other things, this can work super well for that. Now, while your money's liquid, it's doing a couple of things. The first one is with life insurance, whole life insurance, you have a guaranteed rate of return, right? Guarantees, something I really like, right? That's a good thing. In this case right now, most companies, the best companies are offering about a 3% guarantee. So that's about what you would get in a high yield savings account. Some people, if you shop around, you can get 4% right now. A couple of years ago, 2 years ago, you'd be lucky to get 1%, right? But right now, interest rates have popped up, and you're getting more than that. But here's the thing, life insurance also follows those interest rates. So in addition to the guarantee, you also get a dividend, right? And I don't know if you know what a dividend is, but it's basically profit sharing. And why would an insurance company profit share with you? It's because the ones we work with are called mutual companies. So a mutual company, kind of like a credit union, you know how credit unions are owned by their members? Mutual life insurance companies are owned by the policyholders. So when you buy a policy, you're a part owner in that business, and they profit share with you each year, depending on how the company's done, right? So technically the dividends aren't guaranteed, but literally all the big mutual companies have paid them for 150 years plus in a row, right? So it's not a guarantee, it's just they've just never not paid, for a century. Um, so dividends right now with the best companies are at about 3.4%. So in total, you're getting 6.4% on your money inside of a savings vehicle, which is a pretty nice savings account. I mean, quite frankly, a lot of people are hoping to get between 6 and 7% in the stock market, taking all that risk, riding the ups and downs, and all that sort of thing. If you can get that without the risk, that's pretty good. But here's what makes this so powerful. Remember I talked about tax breaks over here? I talked about tax breaks over here. It's because this vehicle has incredibly good tax treatment. So once the money goes in there, you have tax advantages, right? And I want to be super clear about this just so you don't have to wonder. How it works is this: you make $1, you're going to pay your tax like a Roth, and then the money goes in here and it grows, okay? Now, technically, it grows tax deferred, which would mean you would pay taxes on it when you pulled it out. But the way I'm going to show you to use it, and this is not gray area, this is exactly how these are designed to be done, is if you use the loan provisions, I'm going to show you in just a second, it grows and you can use it tax-free. Okay. So let's look at this. If you're getting 6.4% after taxes, for most of you, that's like getting 10%, paying the taxes to end up with 6.4%. Do you see what I mean? So your net here feels like what you would get in another investment or other kinds of things. You'd have to earn 9, 10, 11% depending on your tax bracket, right? So this is a really powerful savings vehicle that allows you to grow your money and keep it liquid at the same time. So if you just use this as a retirement plan, and this is honestly, this is just the first step. This isn't even the banking system. I just have to help you understand the tool. It's a really, really powerful way for people to build wealth. And honestly, pre-1978, which is when the 401k was invented, most people had a pension and they had their home and they had life insurance because it was dependable, right? We all wish we could get pensions these days, but they're really expensive and hard for companies to do, so they don't really exist. So companies push everybody into the stock market. But life insurance has been one of the foundational tools for hundreds of years to help people build wealth, right? It's just the flash and dazzle of the stock market has gotten a lot of people excited. And lately it's crypto and it's fintech and it's EFTs and it's all the other buzzwords. But at the end of the day, this is something that's been tried and true for hundreds of years. I think life insurance has been around 350, 400 years. And the one last thing that this does is it's going to grow and ensure legacy. it is life insurance. There is going to be a death benefit that pays out, but it grows over time. So what happens with this is when you build a life insurance policy, you start off with it's called your base death benefit, right? That's what your $1 here is paying for, is your starting death benefit. But every time you put money in here into the cash value account, the life insurance company gives you a chunk of death benefit to back your money. Okay. And it's not, if you put $2 in there, it's not just the $2. Life insurance company's like, well, we get to use your money until you die. We're going to make money on that money. So we might give you, for every $2 you put in, we might give you $4 or $5 of death benefit. So as you stack cash in it, your death benefit grows bigger and bigger and bigger. It builds these bricks of one-time payment insurance. They're called paid up additions. I'll put that up here, PUAs. And your policy has to be built with those to put the extra cash in. But essentially what it is as your money stockpiles in here and is growing, if you pass away without spending any of it, then your heirs will get all of this money, the base death benefit plus all the growth, tax-free. Now, what's more likely to happen is somewhere along the line, you're going to use it, because I'm going to show you how to do that in just a second here. You're going to use it and it's going to cancel out some of these bricks as you pull the cash out and take loans against your policy. So let's say you've used half of it. Your heirs still get the other half plus the original death benefit tax-free, right? Or let's say you spend every single penny out of this, right? You use it all for retirement. You have a great time. At the end, your heirs still get the original death benefit tax-free. So either you get to spend it or your family gets to spend it tax-free. And it guarantees there's going to be a legacy there, something to pass on to help your kids be in a much better place than you would have been when you came along, right? Unless your family set this up for you. So this is kind of the first piece. If you just use this like an IRA or a 401k, your money would grow right now at 6.4% tax-free, plus you'd have a death benefit. You'd be able to get to the money, and there's a lot more to it. But it's a really great, stable thing that's always going to go up. A lot of you, I know a lot of shop owners are in their 40s and 50s and beyond. You've been around long enough to see the ups and downs. We all remember '08. We all remember 2001. We all remember some of the ups and downs in the early 90s. The reality is it's nice to have chunks of money that always go up. They actually increase the value of your other assets, which is a whole nother topic we can cover some other day when you use them together, but is a really powerful foundational tool to store money in. Now, I'm going to show you how to put this on steroids, but I felt like I had to cover that. Have any questions popped up, Jimmy?
Yes, in fact, there's been two, and I was going to save them for the end, but you asked for questions, so I'm going to give it to you right now.
Sure.
Number one, now this comes from, I don't know if he wants a shout out on it or not.
You don't need to do that. It's fine.
So the question is from, no, there's no question from. I have an MMA, mutual money account. I'm assuming that's what it is. It's earning 4 to 5%. Is that a viable option for your service, for your scenario? Is there any negatives with an MMA money
MMA.
market account?
Oh, I see. Yeah. So money market accounts can be a really great liquid place to store cash as well, right? There are some differences. It doesn't have the same tax treatment,
Uh-huh.
right? That growth is going to be taxable. It doesn't come with the death benefit. But if you're pushing money in and out of things, then it can be good because it is a little bit faster turnaround than life insurance. And I'm going to
Hmm.
show you a couple of other things. There's a thing about life insurance, and I'll show you in a sec how this works, but I'll say it now. Life insurance actually creates an unbroken compound interest curve, even if you use the money, which might sound weird, but as you're pulling money in and out of your account, every time the money goes out, you stop earning. And then when the money comes back in, you earn. Life insurance actually, there's a way to use it and it never stops growing. And so that's probably that and the tax treatment are the two real big differences. But a money market account is much better than a typical savings account to store cash
Hmm.
in, for sure.
Nice, nice. So, and if I remember right, your program also allows the dollar to do seven different things, where an MMA might only allow it just to do the one or two things.
That's right. Yep.
Okay.
Yep. And we'll get into those, you guys. All so just to kind of articulate that, Jimmy, while
Mm,
your money's liquid, it's earning one way, it's earning the guarantee. Two ways, it's earning a dividend. Three ways, it's saving you taxes. And four ways, creating legacy. And we could even say in this particular case, five ways it's creating leverage. You're using a small amount of money to create a large asset, right? Which is a death
yeah.
benefit. So this does a bunch of jobs. I'm going to show you how to add some more ways to that. But if you just stick it in there and never touch it, it's doing all those.
Nice,
Yeah.
nice. Yeah, and I think when we've looked at this before, there's like a few more options that you're probably going to go into here in a
I
minute.
I am,
So-
yeah.
okay, so
So
we won't give away the prize
yeah,
here. A question coming in from Todd. He and his wife have life insurance policy through Northwestern Mutual for,
good
would
company.
it
Yeah.
make sense? Would it make sense for him to switch this to your life insurance policy? And I'm not going to answer for him, but they're
Yeah.
both 61, if that matters. His current policy, he owns part of it and he rents part of it. That's
Mhm.
probably language you understand because I don't understand that part.
Yeah. So first off, Northwest Mutual it's right in the name, right? It's a mutual company. They pay a pretty good dividend. So they're a really good company, right? Um, you probably wouldn't want to switch companies, and you
Hmm.
could use your policy the way I'm about to show you. You probably would not want to unless you got the policy in the last year or two, like early on. In life insurance, most of the fees are in the first couple of years. So once you're past the first couple of years, a lot of times it doesn't make sense to change unless you're with a company that's really underperforming or your policy was built with all the money going in here. So it's just growing cash too slow. So I think that's
Mm.
something we could review. I'd be happy to look at it and see. But if it's structured properly and you've had it more than 2 years, there's no reason for you to change. I
So here's
mean,
another question for you, Derek.
yeah.
Let's say for Todd's example, he's got a good thing going and
Mhm.
it's longer than 10 years. He's had it for a long time.
Sure.
Can he open multiple policies?
He can. He would have to qualify for new policies because what the
Okay.
insurance company's looking at is someday they're going to have to pay on this. And when they
Right.
pay out, they need to make sure that they're collecting enough money to pay that, earn what they need to earn, and do their thing. So yes, you can definitely I'm not the most extensive person because I've gotten pretty big chunks as I've gone. I've got six different policies on myself. A good friend of he's pushing 30, which sounds a little crazy, but there's a way to simplify all that. But yeah, there is no limit on how many policies you can have, but there is a limit on how much death benefit you can get. This is a terrible way to say it, but like the insurance company doesn't want you worth more dead than alive. So a lot of times they're looking at your earning power. And if you make $150,000 a year and you're 35, so you're going to work for 30 more years. They're going to look at 150,000 times 30 years. You're worth about, or at least $4.5 million to your family as an earner, right? Not as a
Hmm.
human, but as an earner. That's what they call your human life value. And that's what they would base how much insurance you can get on. So whether you had 10 smaller policies or two bigger ones or one bigger one, that's kind of how the companies tap out, and they all communicate. So when you go to get a second policy, Todd, you would disclose how much death benefit you currently have, and they would add that to that total and look at that. If you're in your 60s, a lot of times they'll still do like 10 times your income. They don't just cut you off and say, well, you only got 3 years left.
Mm.
Usually it's 5, 10, 15, depending on your situation, what's going on.
Well, and that leads into the last and final question, and then we'll keep going because there's some great information coming, you guys. Jeff is asking, what about for shop owners who are over 60? Does
It
it
can
still make sense compared to the cost of the death benefit payout? Does it still make sense to open up a life insurance policy?
It can, right? And in a lot of cases, it does depend on your time frame. If you're looking at this and saying, I want to retire at 63, there's not a lot of time for it to work, right? And
Right.
so you would be looking more at the death benefit piece of it. However, if we're looking at, I would say 5 or 6 years or longer, then it still makes a lot of sense. And
Mm,
especially if you've got other assets, this can enhance the value of those. And like I said, that's like a whole nother strategy if you want to Google what a volatility buffer is and how that works. I've also got a video on my YouTube channel that's how to double your retirement income. And it talks about how to use life insurance with other assets like a stock market portfolio to increase the money you can pull out of the stock market.
hmm.
So it depends. In a vacuum, it may or may not make sense, but if you're looking at anything more than I would say 5 or 6 years as a time frame, it probably makes sense to consider. And the other thing I will say, Jimmy, is we actually to accelerate this, we use what's called a high early cash value policy. It's a specific policy with Mass Mutual that right now I think is the best policy on the market because your cash early on in the policy is really high, so it it minimizes that cost of insurance. A lot of the commissions that would normally go to an agent here get paid out instead of in the first year, they get paid out over 10 years. And so all
Mm.
that commission that normally would have gone to your salesperson goes in your pocket early on in the policy. And over time, it catches up and works out. But when we're talking about shorter time frames, it makes a really big difference. So,
Oh yeah.
yeah,
And I think that's where you've really resonated in the automotive industry is you're not out after your own dollar. You're here for the long haul.
yep.
And these shop owners want to know that you're not fly by night, which is true. Your commission is based over the next 10 years, not today.
Yeah, yeah. And honestly, life insurance is one of those things where if someone becomes a client, you're gonna work with your agent for
Mhm.
theoretically the rest of your life, right? And so
Yeah.
you want people who have been around, who understand how it works and can be there for you. Obviously, the insurance companies will be there and all that if your agent left, but that's part of what we bring is we've got a company that's got multiple agents. If for some reason somebody had to leave or change careers, I mean it happens, right? We've got a
Hmm.
team that can pick it up and they understand what's going on and they can help guide you through it. But yeah, we're really, I mean, I'll be honest with you guys. If we work together on life insurance, chances are you're going to need other things down the road that we do. A typical shop owner for me, if we work together for a long time, is worth maybe 6 figures, right? So it's worth it to me to invest in you, do the right things for you, make sure you're being as profitable and as wealthy as possible because it works for me too financially. So it really is a win-win if we do this thing right. It's not a make a sale, you'll never talk to us again. I know people do that and you can kind of make a living that way, but you can't really build a business. I mean, if you guys did that for people and didn't do great service, yeah, they might buy from you one time, but you wouldn't get the referrals, they wouldn't come back. It's just a really, really hard way to do business. So we're just not wired that way. So, okay, because we're tighter on time, I want to go through this second piece. This is where this gets really fun. So, as you build money up inside of your life insurance policy over time, your cash is going to grow. So, this is your cash value. And this is something each of you will understand if you own a shop is you got to buy stuff, right? You got to buy equipment, you got to buy lifts, you got to redo the shop, whatever. Let's call this a piece of equipment. Okay. So you need to buy a piece of equipment. Instead of going to the bank, you're going to go to the insurance company and you're going to take a loan against your policy. Now, there's setup for this. It's super easy. You literally fill out a little form that says send the money here. There's no qualifying, there's none of that because you're using your own cash as collateral. The money comes from your cash value. And let's say this is an $80,000 piece of equipment, right? Bunch of diagnostic equipment or something. So you're going to take that $80,000. Now, your $80,000 actually stays inside of the policy, and you're going to get a collateralized $80,000 loan. So that's why it's a loan against your policy, not a loan from your policy. You take this $80,000, you pay for the equipment cash, and now you've got all your dollars stacked in here in equity inside of the equipment. Now, here's the thing people think equity is a good thing. But the problem with equity is once your dollars are trapped inside of that equipment, they stop earning. I jokingly call this the dollar graveyard. This is the skull and crossbones, right? Stick figure action. but your dollars are dead. They're not making the asset or the equipment worth anymore. They're not saving you taxes. They're just sitting in there. Now they do a not negative, right? They keep you from having to make a payment to the bank and pay interest. It's not a positive, but it's not a negative either, right? It's kind of a not negative. So what we want to do is we want to figure out, how do I keep this money that's trapped in there working for me? And the way that we do that is we use this 1% banking strategy. We think like a bank, and we say, okay, I'm going to pay myself back on this loan, but not just pay myself back the principal. I'm going to charge myself interest just like if I got a bank loan, right? So let's say you got an equipment loan, it was 7%, right? Equipment loans ain't cheap. We all know that. To the business over here that's got the equipment loan, it feels the same as if you're paying the bank back, right? You're making that payment every single month. The difference is this this 7%, you're earning on those dollars, you're earning 7% until it gets paid back into your policy. And inside your policy, you're still earning your 6.4% tax-free, right? So your dollars are either working inside the policy or inside the equipment until it's paid back. What that does is it makes sure that your money never stops working for you. Day or night, inside the policy or out, it's earning for you. Okay. Like I said, to the business, it doesn't feel any different, but you're recapturing all that interest that would go to the bank so that it can come into an account that's going to grow and compound for you for the rest of your life. And once it's paid back, you can do it again, right? Now, I got to be honest with you. First time I saw this was 15, 20 years ago. I was like, wait, taking money out of my left pocket, I'm putting it in my right pocket. Is this like smoke and mirrors, or is there like a real value here? Because it felt a little bit like, is this real, or is this just a way to sell insurance, right? So let me show you how this actually works. If this line is $0, when you go to buy a piece of equipment or a car or remodel your house or anything you'd have to put some money into, you only have two choices. The first choice is you go negative $80,000 in this case, and then you make payments back to the bank until you get back to zero, right? Once you're there, it's paid off, you're good. But along the way, in addition to principal, what are we paying the bank? We're paying interest, right? You knew that. We've all done too much of that, right? So there's a cost to borrowing money. No shocker there. But here's the thing, the only other option you have when you buy something is you got to pay cash. Well, let's say to build up 80 grand, right? You build it up and then you're going to go pay cash for it. Let's say that takes you 5 years. What is your money not doing while it's building up in a savings account? It's not earning, right? Or it's not growing. Now, here's the thing. This is an unseen cost. All that money you got sitting in your bank account right now, earning very little, the bank doesn't send you a check and say, hey, if you've been earning 6.4%, here's what you would get. Now send the check back. You just don't ever see it, right? So you're unaware of the cost of that. And people say to me all the time, well, what if I already have the cash? Well, then you've been paying this price for a while, right? Missing out on the earning potential. This equation solves that problem. While your money's in here, you're getting the guarantee plus the dividend tax-free. It's just growing and spiraling on itself until you deploy it and use it to buy. And this could be a piece of equipment. This could be a real estate property. This could be cars. You guys know people buy those, right? We all have all kinds of stuff that we're getting loans on. The money goes in there, and then you pay yourself back instead of paying the bank back. So what we can see from this whole equation is you either pay interest or you pass up interest on everything you buy. When you do it this way, you get to collect the interest and you get to earn while you're building it up. So it solves this problem. Now, let me show you what this turns into. Let's say you had an $80,000 loan at 7% over 5 years. You would pay about $14,000 in interest on that, just so you know. Now, those of you who didn't go to business school, if you, when you, well, let me back that up and I'll go one more time here. A lot of people would say this loan cost me 14,000 bucks, right? That's what I sent to the bank. That's money I don't get to keep. Here's what people miss. Once you give this money to the bank, it's no longer yours. And what you're actually giving up is not just $14,000, you're giving up what it could have turned into if you'd been able to keep it and earn on it until retirement. Okay. So this is where the math comes in. The rule of 72, it helps you understand compounding interest. And I'll just tell you at 6%, your money, here's 72, your money double every 12 years. Okay. And this works for everything. At 8%, your money will double every 9 years, right? 72, I don't know why it's the magic number, but it is. So let's just say 6%. If you had paid this to yourself instead of to the bank, this $14,000 in 12 years would be worth $28,000. In 24 years, depending on how old you are, right? $56,000. Or for some of you that are a little younger, or if you don't spend this right as you retire, 10 or 15 years into retirement, 36 years down the road, this is going to be worth $112,000. That's what that loan cost you in opportunity cost, right? Potential earning you could have gotten, but didn't because you sent the money to the bank. So this helps you to recapture all the interest that would have gone to the bank and let it grow and compound for you. Now let's just use this number. 56,000. So if you're 50 and you're going to retire it, then start using this money at say 75. $56,000 isn't going to change your life, but that's only one transaction, one time. I work with shop owners all day, every day, and we used to interview hundreds of them to do R&D credits, research and development credits. Guess how many vehicles shop owners buy? Guess how much real estate? Guess how many pieces of equipment? You guys are doing loans like this almost every single year. So when you start going, oh, that's $56,000 a year that's going back in my pocket, tax-free. This isn't 56 grand that you're paying taxes on. Every single transaction, suddenly over the next 20 years, that's 7 figures plus that you did just by not paying the bank, right? This isn't going out and becoming an investor. This isn't taking risk. This is simply taking the money you would have paid to the bank and paying it to yourself. Now, I mentioned the guy asked about the money market account. Here's how this works. When you take a loan against it, normally what happens is you start to build money up and then you got to buy a piece of equipment. So you're back to the slow part of the growth curve, right? And then you build up some more money and then you got to buy a car, build up some more money, you remodel your house, whatever. You never get to the part of the equation where the money really grows up here. We all know it's a real slow down here, but when the snowball gets up here, it gets really fast. With life insurance, because the money never comes out, it stays in here. Yeah, you have an offsetting loan out here, but once you pay that back, this money never got slowed down. And this creates a massive snowball for you over time that you can't really get anywhere else. We all know that Albert Einstein said, compound interest is the eighth wonder of the world. The problem is when you have things where the compound interest curve is broken, that's not true. And that's part of, if you know me, I don't love the stock market for business owners. It does this, it keeps breaking the compound interest curve, so it doesn't grow the way that it could. What we love about life insurance is the consistency and the ability to not break that curve as you use the money. So with your money market account, you're playing this game, even if you're getting a similar interest rate, but you're also here, you're not breaking the curve and you're growing it tax-free. So that really makes a big difference over time. I'm going to throw one more thing in here, Jimmy, especially because I know shop owners think this way and care, many of them care about legacy. So that banking system is really powerful for you as a business owner, but this is something you can do for your family too, is let's say you have a trust and you put some money in there. This trust can now buy insurance policies on each of the kids, right? Each of the heirs, or it could be you and your spouse and the kids, but it can buy these policies. The trust pays for the policies and helps to build up cash in there. It might even be that there's an insurance policy in the trust that's paying for these. The kids get to use this to go to school. So now that all that student loan debt, they're paying themselves. buy a car, get married, start a business, all the different things they're going to buy a house, all the things they're going to do in life. And they're taught how to pay it back to themselves. So they're learning how money works. But just think back on your life. All that money that you've paid in credit cards, in equipment loans, in business loans, in student loans, in whatever, what if all that interest had been going back into an account with your name on it to grow and compound for you for the rest of your life? Make a huge difference in how much you have now, right? I mean, there's a reason that banks have their names on all the biggest buildings in the country. It's not an accident, right? Uh, this happens and the kids get to use it. And here's the thing, when they pass away, the death benefit goes back into the trust. And now there's money in here to pay for the next generation. So once this thing is funded and set up, it becomes self-funding. The death benefit pays back all the payout of the trust plus some and can grow. And then the next generation gets to use it. And you can do this over and over and over. The Rockefellers, who I mentioned earlier, have been doing this for 6 generations so far. Last I heard, I think they were at like 147 people benefiting from this. But it's a huge way to keep the money in the family. And kind of a cool fact for those of you who care, Motown was actually founded off of a family bank like this. It was several people who put their money, family members put their money into something like this. But a lot of things have been done with this type of setup. And ultimately, what this creates for you guys is a high interest, tax-free savings account that's going to help you recapture all the interest you normally would have paid to banks and creditors and all of that, but in a way that when you pass away is also going to come back out as a death benefit to your family tax-free. So I think of it as like a Swiss Army knife of finances. It does a lot of jobs, which is why we're covering it today. It's not just one strategy. Going back to what I said here, it helps to enhance everything you're going to do anyway. And it gets banks out of your life once you get enough money in there. So, and just so you guys know, if you're interested in seeing what this looks like for you in a second here, I'm going to pop up a QR code and you can set up an appointment to talk to my team. I know some of you are in your 30s and 40s, some of you are in your 60s, some of you are married, some of you are single. There's lots of scenarios. The good news is we can work through it, and my team is very experienced and can help you to see the numbers, see what it looks like for you. Life insurance is one of those things that you have to qualify for. So we usually have you qualify for a policy, and then we look at the numbers and see what it really looks like for you. So I guess I'll pop up that slide while Jimmy. So for those of you who are interested in that, you can either go to biglifefinancial.com/institute, and you can set up a free consultation to talk to my team, or you can just scan the QR code here. It'll take you to the same place. Don't scan the QR code and think you're going to come back to it. You won't. Just all you got to do is put in your name, phone number, and email, and then pick a time on the calendar. So I'll let you guys do that while I answer questions here. Jimmy.
Yeah, question. All right. Number one question. Archangel has a question. I have a key man policy that earns cash value. It's owned by the business, but it's put into a trust. It's a policy that can be leveraged similarly. Is that a policy that can be leveraged similar to what you're describing? I asked for more qualifying information. I said the purpose of the, and he says that the purpose of the policy explained to me is to provide a financial payout to the company if the executive or the key member dies or becomes too disabled to work, so the company can keep operating until it finds a replacement for that person. So I've seen a lot of shops do this for their service advisors, their managers. I mean, it is crippling when you are down a service advisor.
Well, and that's why the word key, we'll call it key person, right? Comes in, is because when you lose that person who runs your shop, or that key person who really makes it all, that's the glue. Absolutely. A lot of partners who do front end, back end, or one guy's the financial guy, the other guy's the shop guy, whatever, they buy them on each other, because if you lose that person, your business does not work. And the point of the payout is to be able to help the business get through that, and maybe even use it to hire the next person so that you can get through that difficult period. Yeah, key man policies are really important. So you can do all of this with the key person policy, provided you control the ownership. So whoever owns the policy is the one. Yeah. So as long as you're the the executor to
Executive of the
the
trust.
trust. Yes, so as long as you have control of the trust could access loans against that policy and utilize them for whatever made sense in alignment with like the business, right? You don't want to necessarily go do a bunch of personal stuff with the business's money in a situation like that. A lot of these key man policies are also done as like benefits to that person.
Person.
Yep, to where at some point it becomes their policy. So if that was the case, you may have some limitations because you can't go borrowing against their asset when that transition happens. So there could be some limitations, but in most cases, you should be able to find a way to do it. It's not super complicated. I just don't have the details.
Yeah. Well, Archangel will be at Summit, so
Awesome. Yeah,
make
then
sure you get
come say
with
hi.
Derek. Yeah, and there'll be plenty of time for us to be able to do that. It's going to be awesome. All right, John's asking, what if you're looking to exit your business in a few years? And I asked
Mhm.
John, I said, what's a few years?
Sure, sure.
Assume it's less than 5.
Mhm.
Is this a good strategy to follow if it's less than 5, Derek?
Yeah, so a simple question to ask yourself with anything, they're all tools, right? Stock
Hmm.
market's tools, private equities tools, real estate, your business, whatever their tools. So what are you trying to accomplish? If you're going to exit the business and then do something else, are you going to retire? How much are you going to exit for? If you're going to exit the business
Hmm.
for $100 million, then yeah, having a life insurance policy where you can stuff a bunch of that cash is a really great thing, right?
Mm,
If you're going to exit and get 500 grand or 250 grand or whatever because you're not totally maxing out the value of the business or whatever, that's a different scenario. So it kind of depends. I think that's one where it makes sense to have the conversation and look at where are you now? Where do you need to go? What tools can get you there? I don't want to say
mm.
life insurance is the answer to everything. It's one of like 50 things we do for clients, but I think this one is the foundation because
Yeah.
you got to have cash. You don't want to pay taxes. You want your money to always go up. You got to protect your family. These are all things you need to do anyway. If you can do them in one place, it's super powerful. And like I said, get your dollars doing a lot of jobs. So it might not be the right tool for you, but there are good tools, and we'd be happy to talk through those with you as well. And then, talk to the Institute about how do you build your business in a way where you can sell it, because that's the biggest thing you can do right now is maximize the value of that business. If you can work with them to get things squared away so that when investors come to buy it or another shop owner comes to buy it, you're the prettiest girl at the dance, then you get your pick of suitors, right? And it makes a huge, huge difference. And you can
Yeah.
add 7 figures to the value of your business relatively quickly if you get that part right. So that's your biggest bang for your buck. But life insurance could be a tool that could work along the way, depending on what you're trying to do. So I hate to do that. It depends, but it kind of
But
does.
it
It
depends.
doesn't solve that all by itself. It definitely works with everything else.
Yeah. Yeah. Well, everybody scan that QR code if you're looking for a meeting with Derek. Scan the QR code, get onto his calendar. One more question coming from Todd. Todd
Sure.
says that when you were talking about the children as part of the business, he has 25-year-old twins that are getting ready to go to medical school.
Okay.
This might be a method of setting them up for life, which I think is exactly what you were talking about with the Rockefellers.
It is. There's actually some really cool tax stuff you can do if you're helping them pay for medical school too. So, but yes, this can be a really powerful way to help them to essentially take a lot of the money that would have gone to the the things that they're going to have to tackle, right? Student loans, eventually going into business for themselves or working, but they're also going to buy houses and cars and all the other stuff along the way. This really does put them in a position to capture all of that. And as medical professionals, I do work with a lot of doctors and dentists as well. It's funny, my industries are doctors, dentists, and shop owners, and people kind of laugh and think, wow, that's really different. And the businesses are actually really, really similar, right?
That's
Someone
awesome.
comes in, you do a diagnostic, you give them a treatment plan of some sort or some sort of recommendations. A lot of times there's insurance involved. Like there's so many similarities, it's baffling. But at the end of the day, they're going to be earning good money. And the more you earn, the more opportunity it gives you to use something like this where you can run a lot of that cash through this system and get it working for them for the rest of their life, even as they're using it along the way. So it can be really powerful. Yes.
Nice, nice. Well, that's awesome. It's interesting as well as um, vetting, confidence building to know that our models are similar to doctors because I always think shop owners' handwriting is terrible as well. So
Well, that might be a similarity too. I hadn't put that one together, but yeah,
yeah, oh yeah, oh yeah, yeah. We're doctors of cars. They're doctors of people.
basically, yeah, that's how I
Hmm.
think of it. So,
Nice. All right. So I'm going to throw my screen up here as well
oh, let me turn off my
as the
screen share.
final. So thank you everybody for joining us today. If you have questions, comments, concerns, lots of thank yous coming in, Derek, by the way. A
Awesome.
lot of people are booking their appointments and that question that was posed before about less than 5 years. Yeah, he's looking at about two and he says he's going to retire with about $5 million. So that's pretty good. I'll get you his information so you can be sure to reach out.
Yeah, I think there's a place for this. Like I said, it's not going to be a one size fits all, but this could be a good place for your safe money. And
Yeah.
when you have safe money, it's kind of like I call it the kite and the string. When you've got a good foundation, you can fly higher, right? So that allows you to do things with your other investments and assets because you've got that good grounding. So when we work with those together, we have a whole thing we call our Pareto portfolio based on the
Hmm.
80/20 rule. And it's really about how to maximize the value of your assets. And life insurance in a situation like what you're talking about could be a good anchor within a bigger plan.
Oh, I love it. I love it. And John's scheduled with you tomorrow, so we'll
Awesome.
be meeting with
Perfect.
him. That's awesome. Well, thank you for everybody for being here. If you've got questions, comments, concerns, you're seeing information about your personal wealth and scheduling with Derek, let's talk about your business wealth as well with the Institute. Scan the QR code. Let's see what the health of your business looks like. Are you ready for that exit strategy? Are you ready for what's coming next? Scan the QR code here and let's get together. Let's talk about your business and what we can do to help you take those next steps. This is some valuable information. Not all training companies are giving out this type of information. If you find this interesting, you'd like to join the Institute, we'd love to welcome you to the family. Give me a call. This is my cell phone right here, 435-669-4940. It's also my email. I look forward to connecting with you soon. Thank you very much.
Thanks, guys.